In regards to ratios that you were asking, I believe financial reporting, financial analysis. I believe chapter 16 might be better, might be chapter 15, but 16 is better. So let's go to 16 and I will show you all those ratios in one place. And bottom line, imagine you have no book. So as soon as you Google liquidity ratios, you will have a very good set of sources to learn liquidity ratios and choose one of them for your project. Same thing do for profitability and solvency. So even Google search will take care of that too. But here in chapter 16, tools for final direct approach, here, maybe that one. If not, then we go to chapter 15. So tools for financial statement analysis, let's see. Yeah, you see here in chapter 16, it gave you two liquidity ratios, which we covered in chapter 4 already. And debt to total asset or debt to total equity ratios or times interest earned, those are solvency ratios. That means ratios that is considering your long-term ability to survive in the business. They want to see how much is your total debt percentage compared to the every $1 of asset. And let's say in this example is 29%. That means 29% of every $1 of asset that you have in your business is paid by borrowing. And probably it's good, probably, but you have to compare to another company to see what is the other company's debt to asset ratio. Same thing in a debt to equity ratio. So you want to see what's the percentage of debt for every $1 of equity. And here you see that for compared to every dollar of equity, there is 41% of borrowing. So 41% of your equity is debt. So your equity is much bigger than your debt. And that's good, because if your debt is much larger, then you have obligation to pay that debt back. You have obligation to pay monthly interest, and that will put you in a risk because it will be considered as a high risk type of company. So debt to asset ratio, debt to equity ratio, those are solvency ratios. Times interest earned, that is that means it's considering how much income you have, actual income, before deducting any taxes or interest, how much actual income you have compared to your monthly interest, your annual interest expense. So if your annual income is 14 times bigger than your obligation of interest payment, that looks good. Obviously, if you compare to another company, that will be much more clear to see which company is having a better chance of having enough earning in order to pay all those obligations of interest expense. So it's solvency ratio. Turnover ratio this is more like management efficiency, and also you can consider it as a liquidity ratio, because in here it will explain that how many times your accounts receivable has been turned over. That means collected completely, and you sold again, and you collect again, and then you sold again, and then you collect again. Like in this company, the turnover ratio is 4.48 times during the year. That means almost 4.5 times this company was able to collect its accounts receivable during the year. Which if you divide 365 by 4.48, that gives you accounts receivable collection days. So 1 year, 365 days divided by 4.48, that gives you how many days accounts receivable takes to be collected. And you have to compare to the other company to see which company is collecting accounts receivable faster. And that will create technically more liquidity and shows better management and efficiency in the management of the business. Same thing in inventory turnover. They want to see how many times your inventory has been sold and purchased again, sold and purchased again, turned over. So if you divide that cost of goods sold by average inventory, that gives you a number that shows that your inventory has been turned over, sold completely, and then purchased again 5.8 times. And that shows how fast the company is moving its inventory and managing its inventory, and technically creating liquidity, because if you turn over the inventory faster, you will create also more liquidity and shows better efficiency in business operation. And here is the profitability ratios again, one after another, few options for you, which again, you can use either one of them. In the profitability ratio, we covered in chapter 5, few of them. So you can, again, either look in chapter 5 or go to chapter 16 and have a very good view of all those ratios in one place. Okay, any questions? Very good. So let's go to chapter 8, which will be tested this week, and let's cover that. So inventory management is very important part of a business. Almost, I can say, most businesses, they have inventory because they are selling something. There is two ways that you have inventory. Either you have a merchandising business, which we cover in chapter 8, or we have a manufacturing business. Again, you have inventory in manufacturing, and that will be covered in managerial accounting, which you can take it with me the next semester or anytime in future. That will be starting chapter 17 all the way to chapter 24, and that will be your managerial accounting. For now, we are focusing on merchandise business, which we call it merchandising business, which is buying inventory, like made complete inventory, and sell the inventory. And that's how we manage it. That's the question. So let's go forward. In inventory system, there is something, obviously watch those videos, okay, please. Very good lectures in here for you. But just to wrap this part here, we have two types of shipping agreement between buyer and seller. So you as a business owner, you need to understand that. And that is either FOB destination or FOB shipping point. That word, FOB destination or shipping point, will be on your invoice when you purchase inventory. FOB destination, this is how I translate it in simple language. I said up to final destination, the seller, you see the truck is green color, you see, and the seller is green color, okay? So up to final destination, the seller is the owner and the seller pays for the shipping. So if the shipping is on December 28th and it arrives on January 20th, so up to January 20th, the seller still is the owner of this inventory in transit and also pays for the shipping himself. And that means this goods in transit needs to be reported in the balance sheet as a form of showing inventory that belongs to the business. However, we have FOB shipping point, and this is how I translate it in simple language. I say from the shipping point, which is as soon as it's in the truck. The inventory belongs to the buyer. You see both of them are green color. And buyer will pay for shipping. So one more time, from the shipping point, the buyer is the owner and the buyer pays for shipping. And that's again important because you need to know if it's shipped on December 28th and arrives in January 20th. That means as soon as December 31st balance sheet is prepared, this inventory is already part of the buyer's inventory. Even though it's on its way coming, doesn't matter. We call it goods in transit, and it will be reported as an inventory in transit in the balance sheet. Consignment is, that means to place inventory in the custody of another party without requiring them to purchase it as a sales agent. So we give our inventory to another company. They have the custody. We are the owner. We call ourselves consignor. The other entity who has the custody of the inventory is the consignee, but the inventory still belongs to the consignor, to us. We are the owner. If we have a balance sheet, it's going to show in the balance sheet as inventory in consignment. It's our inventory, it's our asset. It will show as inventory in consignment. The consignee is just having a custody of it. Whenever the consignee sells it, he gets a small, let's say, commission, and he pays the dollar, whatever it is, dollar amount back to the owner, which has the title. But as soon as it's sold, then it's sold. It's good. Other than that, still is the owner has the title. Again, make sure you ask questions if something is confused. Okay. So here is the concept of base, which I taught you already. If you remember, I said in order to calculate the cost of goods sold, you can use base, B-A-A-S-E. And just plug in your numbers and calculate the cost of goods sold. So let's say beginning, it's first B, beginning, plus added is available, and minus ending inventory gives you cost of goods sold. So B-A-A-S-E, beginning, added, available, subtract, and very useful concept in accounting and in multiple choice situations. So here we have the available inventory, and this available inventory, we know what the ending is because we do physical count at the end of the year. Therefore, available inventory minus physical count at the end gives us the cost of goods sold. The cost of goods sold goes into the income statement. We call it sales minus cost of goods sold equals gross profit. And ending inventory as a form of asset goes into current asset section of the balance sheet. The same picture anyway. Okay, the cost flow assumptions are important because you have to assign a cost flow system in inventory accounting and keeping records. And when you create a business, you need to also report this cost of inventory accounting method to IRS. IRS wants to know which one you are going to use, first in, first out, or last in, first out, or weighted average. First in, first out, that means the first inventory comes in is the first inventory goes out. Let's say you have 30 t-shirts, bought 30 t-shirts, one of them $10, then $11, then $12. So it looks like you have 30 t-shirts at different prices. And you sold one of them. Let's say you do FIFO. If you do FIFO, and IRS already is aware of that, so that means you sold the first t-shirt which you bought it for $10. However, if you do LIFO, that means you sold the last t-shirt which you bought it for $12. The average is what you have to calculate. The average, you have to say, okay, I bought 3 t-shirts for $10, $11, and $12. Combined is $33 divided by 3 t-shirts. The cost is $11. So it doesn't matter which one you think you are selling, still you are selling based on the average cost. So here are some examples about that, and you can just study that, but the sample of t-shirt that I just told you, it is a good way and simple way to calculate. So you have 3 t-shirts, you bought it one at $10, one at $11, one at $12. So what is your average? Your average will be 11. 10 plus 11 plus 12 divided by 3. If you sell the first t-shirt, then the first t-shirt is $10. That's what you are selling. First in, first out. If you do last in, first out, that means you are selling the last t-shirt which you bought it for $12. That's simple. Okay. And here are 3 other examples in the book for you to look at. So in under FIFO method, always the beginning inventory will be sold because it's first in, first out. So beginning is the first. So that will be sold at that year. Always the ending inventory is from the purchase that you did the latest. And on the last in, first out, the beginning inventory, whatever it is, it will stay. You are selling always the last series of purchase of inventory. So this we call at the end of the year, we call these 3 boxes left over, we call it LIFO layer. LIFO layer, that means a layer of inventory that has been left over at the end of the year 1. And then in year 2, again, you purchase a lot of inventory just like this, and then you sell it. And because a little bit more than 3 boxes, let's say, is left, let's say your leftover boxes are 2 boxes. So 3 boxes will be LIFO layer of year 1, and the other 2 boxes will be LIFO layer of year 2. So in last in, first out, at the end of each year, if inventory is left over, it will be based on different layers. And every layer, you have to keep the record that what is left at the end, at what average price. So the average, it goes by average price. Why it's average price? Because here you see you have 3 boxes, but even those 3 boxes, you might purchase them at a different price. Let's example the t-shirt. So imagine at the end of the year, you have 3 t-shirts left. Those 3 t-shirts, guess what? You bought it, one of them for $10, one of them for $11, one of them for $12. Very good. However, at the end of the year, this combined is a LIFO layer left over at the end with an average price of $11. 10 plus 11 plus 12 is 33. Divided by 3 is 11. So LIFO layer at the end of the year, when you want to keep the record of it, you just go with one line. You say my LIFO layer of year one is 3 t-shirts at $11. Got it? It's very sensitive issue, so important for you to understand. Maybe it's not in the book the way I say it, because your book goes a little bit faster about this, but I want you to understand a little bit more in depth. And also, last in, first out is not acceptable under IFRS, International Financial Reporting Standards. It's only acceptable under US GAAP. And the reason is, in the US, those big oil companies, they really like LIFO. The reason is, like example right now, for example, the gas price is very high, right? So right now, these oil companies are making crazy amount of profit, right? And they look so guilty, and they feel so guilty. And they want to create the income statement. So in order to show that, okay, we are not making that much profit that you think, so that's why they do LIFO, because they say last oil that we purchased and sold, it was expensive oil. That's why we didn't make that much profit. Got it? So that's why oil companies, gas companies, energy companies, they like LIFO to show a little bit, less, more moderate amount of income, and don't create a big deal because people get pissed off at these companies who are making so much money right now while people are under pressure. However, under all of US, there is not that much lobbying going on, and so under IFRS, last in, first out will not be accepted whatsoever. Also, in the US, the IRS has a LIFO conformity rule, which says if you want to use LIFO for your inventory accounting method, you have, under IRS conformity rule, you have also to use LIFO for tax purposes. And that means under LIFO, you will sell last in, first out, and that means you will not only for tax purposes, you show less income and you pay less taxes momentarily. Also, in your book, you will show less income, and that will also be hopefully, fair in regards to showing less income compared to your competitors in Europe. So let's say if you look at two oil companies, one in Europe, one in US, like Chevron and Shell, for example. So Chevron in US, if sells exactly the same thing that Shell is selling in Europe, let's say identical, and everything identical, Chevron using LIFO will show less income because it's selling the last oil he purchased and last oil he's selling. So last oil is very expensive. That's why the amount of profit is less. So it will show less income and pays less taxes, obviously. But Shell doing the same exact thing in Europe, because they are following IFRS, so they are doing, let's say, FIFO, and they have two choices, either FIFO or average anyway. So let's say they are doing FIFO, first in, first out, and because of that, the first oil that they purchased, I don't know, last year, it was very cheap, and now they are selling it, and they are making crazy amount of income. And of course, they pay more taxes because of that. So you compare the same company, Chevron, with Shell, you will see that Chevron is less profitable, looks like, and Shell is more profitable. Weighted average is just combination. So you have to account how many units you have total, how much did you pay for them. So then divide the dollar amount total by number of total units, and you get an average cost. And based on the average cost, you can easily calculate what is your ending inventory value for your balance sheet and what is the cost of goods sold for your income statement. Any questions so far, please? Okay. So here, there is a detailed example again for each one of them, FIFO, LIFO, and average. So you can check and read those little examples, but I already explained the foundation of these three and the differences, and also the differences in regards to taxation and amount of income. So FIFO, in a market that creates the highest income, highest prices are keeping going up and up and up. In that type of economy, first in, first out will show that they are always selling the cheap inventory purchased last year or previously a few months ago, and that's why they are selling those and making more money. But under LIFO, they always show that they are selling the inventory that they recently purchased, and that's expensive one, and that's why they make less money. Here under FIFO, because they are selling the first inventory, the ending inventory will be the expensive inventory. That means in the balance sheet, they will have higher income, higher asset inventory balance. So under FIFO, in an economy that prices are rising, the balance sheet will be higher and the income statement will have higher profit. Lower cost of goods sold, higher profit. Under LIFO, the ending inventory will be based on previous purchased inventory, which is very cheap. So the balance sheet asset will be lower and the cost of goods sold will be higher. That means net income will be lower. And because of lower net income, they will also pay less taxes momentarily, of course. Under weighted average, it will be somewhere in the average between FIFO and LIFO, as the name says, weighted average. And when here we say weighted average, as soon as you see weighted average means we are doing periodic method of accounting. If it says moving average, that means we are doing perpetual method of accounting. Now we're going to go over that periodic and perpetual and see the differences. So here is the example of FIFO, LIFO for you, and see the differences, what is left. And you see the inventory balance under FIFO is the expensive higher dollar amount because the leftover inventory is from the inventory that we last purchased and is very expensive. But under FIFO method, the cost of goods sold is the cheap inventory. So it will be less cost of goods sold. That means higher profit and eventually paying higher taxes momentarily. So on the LIFO, look at the inventory. Inventory is much less compared to 85, doing the same thing exactly, but here shows less inventory in the balance sheet and less income. So on the LIFO, you have less inventory, less income. And because of less income, obviously you pay less taxes also. Under weighted average will be somewhere between FIFO and LIFO. As you see, somewhere between FIFO and LIFO. And the profit will be somewhere between FIFO and LIFO. And here is the comparison of those three methods side by side. So under FIFO, inventory will be higher, profit will be higher, under LIFO, assuming in the market that prices are rising constantly. So inventory will be lower and profit will be lower, and they will pay less taxes momentarily at that point. There's also one way to do besides those three is specific identification method, which is inventory costing method, where the actual cost of each unit is very easy to track, and we're going to use it that way. So for example, if you want to buy a car and you do the test drive and you like it, the salesperson will take the VIN number of the car and takes it to the office. And at that point, based on that VIN number, exactly they know what car they are selling, exactly they know what is the invoice for that specific car, and they can exactly tell you how much profit they are making for that one specific car that they are selling. But you cannot do specific identification method for so many things that they are homogeneous and you are producing millions of those, and that's not going to be used. So specific identification method is good for cars, jewelries, something that is a specific job. So I was talking about perpetual method. So what is perpetual method? Under perpetual method, that means perpetually, constantly, you can have information about your cost of goods sold and inventory balance at any given time. So if you, let's say, go to Macy's and you buy a t-shirt, immediately after they scan your t-shirt, the computer will deduct one t-shirt from the inventory, will recognize the cost of goods sold, and Macy's immediately knows how many t-shirts are left in the inventory. But if you go to a mom and pop business, they're not gonna do perpetual. They're gonna do periodic. That means they don't have a sophisticated software where they can scan the t-shirt and deduct the t-shirt from the inventory automatically and recognize the cost of goods sold automatically. So if you go to a mom and pop business, you tell them, I want one of t-shirts that it's on the shelf. They give it to you, they sell it. They know how much they sold it, but that's about it. They don't know the updated cost of goods sold or updated inventory balance. They don't know any of them. So perpetual method is much more sophisticated, but needs a software to do it. You can have perpetual FIFO. You can have, let's say, perpetual average. Normally, you don't use perpetual for LIFO. If you want to use LIFO, that means you're going to do periodic. So for LIFO, we do periodic. LIFO periodic, average, weighted average periodic, or FIFO periodic. That's fine. But for perpetual, normally you just use FIFO perpetual or moving average perpetual. As you see, I don't call it weighted average perpetual. I call it moving average perpetual. The reason is moving average because every time you buy a t-shirt, then you are changing the moving average in the inventory cost. So here is the so-called perpetual FIFO. That means in this example, if you look at, you see you are purchasing 6,000 units at $16. So your inventory now has 4,000 at $12 and 6,000 units at $16. So the total is $144,000 worth of inventory by March 5th. But in April 17, you sold 7,000 units. So because this is FIFO, first in, first out, so the first number comes from the layer at the top, which is 4,000 units total. That will be the first. And then that's not enough because we need 7. So we add another 3,000 units from the second layer, and that will give you the total cost of goods sold for the for this transaction that we sold 7,000 units. So the cost of goods sold will be $96,000, and the leftover is from the second layer, which is 6,000 minus 3,000 sold. That means 30,000 left. So keep that layer available over there. And then in September, you bought a brand new set of inventories, 8,000 units at $17 this time. As you see, prices are rising. So 3,000 comes from the previous layer. 8,000 comes from the new purchase layer. And now in November 11, we sold 6,000 units. Out of that 6,000 units, 3,000 comes from layer number 1 at top here. And then that's not enough. So we take another 3,000 out of these 8,000 units at $17. Combined, that will be my cost of goods sold. And 8,000 minus 3,000, it's 5,000, which goes to inventory layer, and we keep it for next purchase or sell transaction. By that time, it's December 31st, and looks like we didn't purchase anything else. So we have 5,000 units left at $17, and that will be $85,000 ending inventory. For the journal entries under Perpetual, you all the time you update the inventory T account for purchasing inventory, selling inventory, returning inventory, getting discount on payments for the inventory. So here we purchased inventory for $96,000 right there. You see that? You purchased it, 96,000. So the inventory will be increased, debited, and accounts payable will be credited for that new purchase. And then you sold $154,000 of inventory as a sales, and the cost is $96,000. For whenever you sell something, you need to do 2 journal entries back to back. Journal entry number 1, recognition of accounts receivable and credit sales. Journal entry number 2, recognition of cost of goods sold and credit inventory. So cost of goods sold will increase in this example, and inventory will decrease in this example. So 2 journal entries when you sell. Again, in September, looks like we purchased another set of inventory for $136,000, which is that one. So inventory will be debited and accounts payable will be credited. As you see under Perpetual method, every time you do something, inventory needs to get updated. And in November, you sold something for $150,000. Yes, right there. And the cost is $99. So here we go. 2 journal entries. Journal entry number 1, accounts receivable debited to increase it, sales credited to increase it for $150,000. And then cost of goods sold will be debited to increase it, and inventory will be reduced by doing credit of $99,000. So as of this moment, you see the inventory is properly updated at $85,000 total cost. So when you prepare your balance sheet, the inventory 85,000 total cost goes in the balance sheet. The sales will go in the income statement, and the cost of goods sold balance goes into the income statement and deduct from sales, and you get the gross profit. Any question, please? Okay. As I said, perpetual LIFO will not be used and is not common to use. So if someone wants to do LIFO, then normally they do under periodic method. But your book is showing for some reason. So whatever it is, if you just want to look at it, it will be the opposite of FIFO, but again, it's not common to use this. But moving average for FIFO, yes.
I'm sorry, I have a question about that. If we look at the perpetual LIFO sheet at the bottom there, there's so ending inventory is a mix of $12 per unit and $17 per unit. Mm-hmm. So is that what you were talking about before now? Yeah. Then if we were looking at that ending inventory and you were to ask what is the price per unit, we would find that average would be 70,000 over 5,000.
Yes. So your book is not telling you that because it's trying to keep it as simple as possible. But yes, if you took my accounting 10, bookkeeping accounting, you probably already covered this over there. But even though this class is a little bit higher class than accounting 10, but in accounting 10, we go more details in regards to bookkeeping and specifically inventory book accounting. So yes, that's how it goes. So in here, you have to have a LIFO layer because this is your last inventory. Yes, I know it's two pieces, but it is your last inventory. So you have to say exactly what is your LIFO layer of year one. So let's say this is year one. So your LIFO year of year one is, look at here. Look at the top. Do you see here? It says 4,000 units at $12. That is that has been calculated based on average of whatever it was. That's why you have such a cute number here, says 4,000 at $12, because that came from last year, right? So let's say last year was year one, and now we are year two. So LIFO layer of year one, this LIFO layer of year one, that's what's gonna stay. LIFO year of year one. That's not gonna move. So now here, you see that this is left. So this is LIFO, last in, first out. So this is what I'm trying to say, that for the doing LIFO, you don't do perpetual because you cannot technically keep that LIFO layer in here. In here, as you see, this LIFO layer, this is gone. I cannot see it in here. So that's why we don't do perpetual LIFO. But here is showing, so I'm trying to explain. So imagine this is periodic LIFO, okay? Which is the common one that people are doing. So periodic LIFO, this LIFO layer right there, it will stay. So in here, assuming I have 5,000 units left, out of this 5,000 units left is technically 4,000 at $12 LIFO layer of year one, and 1,000 at, let's say, $17 is LIFO layer of year two. So you have to show that at the end of the year, you have two LIFO layer left. LIFO layer of leftover of year one and LIFO layer of leftover in year two. In year two, here you might have three different prices, $17, let's say $16 and $15. That's fine. That 17, 15, and 16 has to be converted into average. And then you have two layers. You call this one LIFO layer year one, and you average of the other three different costs will become LIFO layer of year two, which you purchased it in year two. Make sense? So you have to have different layers. And sometimes you have inventory of 4 LIFO layers from year one, year two, year three, year four, and you are not touching them until one day, let's say you are selling t-shirt, for example. You purchase, for example, 5,000 t-shirts, and then you sell 9,000 t-shirts during the year. So you purchase less and you sell more. In that case, you are selling the old LIFO layers, which we call it LIFO liquidation. And if you do LIFO liquidation, that means you are liquidating your cheap previous layers of inventory. In that case, you have probably high income compared to other regular year. And because of LIFO liquidation and higher income, unique situation, you have to disclose that in your financial data that our income compared to previous years has been higher because of LIFO liquidation, which we liquidated our cheap layers of inventory from previous years. And this way we are just telling you why such a high income happened. So you know that that doesn't mean it's going to happen next year also. The only reason is because we purchased only 5,000 t-shirts, but we sold 8,000 t-shirts or 9,000 t-shirts. So we sold more than what we purchased, and we start liquidating our old layers of LIFO. That's why we don't do perpetual in LIFO, because as you see, the LIFO layers are kind of mixed up. There is no LIFO layers here. It's because here is my LIFO layer. I have 4,000 units, right? But I cannot see it. It's gone. Good question. So for FIFO here, my moving average, you have one layer from beginning, but you just purchased another new layer in March. So immediately in this situation, computer will calculate the average for you. It says, okay, you have 48,000 plus 96, that's 144,000 divided by 10,000 units. Your average cost is $14 and 0.400. You have to go at least 4 decimal in this situation, okay? 4 decimals minimum. And that's your average cost. And now your cost of goods sold in April 17 will be 7,000 units at average cost of $14.40. And 3,000 units left at the inventory at average cost of $14.40. And you keep that layer available, and then you purchase another 8,000 units at 17, you immediately calculate the average one more time. That's why we call it moving average. That means your average is constantly moving. So here is 3,000 at average cost of $14.40 and 8,000 at cost of 17. Total 179,200 divided by 11,000 units available. It gives us an average cost of 16.2909 per unit. And if you sell something in November, so that's 6,000 units sold times $16.2909, it gives us a cost of goods sold of $97,745 and gives us a remaining balance in the inventory of 5,000 units at the average cost equals to $81,455. And that goes into the balance sheet as you see. So that's how you know it's 81,445. And the cost of goods sold will go into the income statement. So this cost of goods sold and that cost of goods sold combined, which will be 198,000, goes into income statement, and you get the gross profit. Any question before we move on? Okay. Now, at the end of the year, as a form of being conservative, you have to see what is the difference between cost and the market value of the inventory you have, and choose the lowest one to be in your balance sheet. So if the cost is lower, you go with the cost, no problem. But if the market value has been declined and is cheaper now for the inventory you have, so automatically you have to use the conservatism. It's a principle in accounting that you have to follow and show the worst case scenario and show the asset based on the market value of the current situation. So what is the market value? Before it was much more complicated to calculate, but recently, last maybe, let's say last 10 years, I say, net realizable value, now it is calculated much easier based on market, based on sales, net realizable value. That means sales price minus cost of disposal. That will be your net realizable value. Sales price, estimated sales price for that inventory at that moment, minus cost of disposal. Cost of disposal is, let's say, shipping cost, for example. That's cost of disposal. So if you, let's say you have a t-shirt, again, you bought it for $10, that's your cost. However, right now, previously you were selling it for $25, which is good. But right now that t-shirt is not popular anymore. It's out of fashion, and you barely can sell it for $12. Okay, and that's fine. But when you are going to ship it to your customer, you end up by paying, let's say, $2 for shipping and $1 for commission. So that will be $2 shipping, $1 commission. That will be total cost of disposal of $3. So your net realizable value is $12 estimated sales price at this moment for the t-shirt, minus $3 for shipping and commission. That will be $9. So the net realizable value of that inventory at this moment, it is $9. Okay, so which one you're going to show? Are you going to show in your balance sheet that you have one t-shirt left for $10, or you're going to be conservative and show the lower of cost or net realizable value, which is $9? Obviously, you have to show $9. So you will write down your inventory by $1 in your balance sheet and show only $9 inventory. And that $1 write down will be recognized as loss in inventory valuation or loss in inventory adjustment to market. So NRV, now it's very easy to calculate, which is estimating selling price in the normal course of business at that moment, end of the year, less reasonably predictable cost of completion, disposal, and transportation. And that will end up to be your net realizable value out of selling that t-shirt, which is $9 in my example. And because your cost is 10, then you have to write down your inventory by $1 and recognize loss on inventory adjustment to market. Any question on NRV, lower of cost or NRV? Okay, so I gave you the example anyway, so hopefully that was a good one. So in regards to inventory estimation method, you have to be sure, you have to do physical inventory count at the end of each year to make sure what is actually on hand available. And that way you can maybe see if there is an employee theft or any damage to inventory or anything else. But in the middle of the year, if something happens to your inventory, they caught fire or something that needs a fast method of inventory valuation, specifically if you do, let's say, periodic method of accounting and you don't know how much inventory you exactly have, you can use a method, we call it gross profit method, which is not good enough to use for financial reporting purpose, but this is good enough for overall estimation of inventory for, let's say, fire reporting to insurance companies or something like that. It's a technique that reports the estimate of inventory and cost of goods sold by applying historic percentage relationship to observable sales commission. So let's see if we have a picture here. So sales is 100% obviously every time. Out of 600, out of 1 million is 60% your cost of goods sold, and your gross profit is 40% out of your sales. So this gross profit method, the 40% will provide enough information that your gross profit is always about 40% of your sales. And then beginning inventory, you knew that because you did physical count last year in your business, and you know how much you purchased during the year because those documents are available. So cost of goods available for sale will be easily calculated based on that. However, you want to know that what is the cost of goods sold, and in this situation the cost of goods sold, which is that number, it's about 60% of your sales, and that means your ending inventory will be about $700. So even though it's ending inventory lost in the fire and you never had a chance to count it, but because you know that your cost of goods sold is 60% and your gross profit is 40%, you can use the percentage of sales that you know for sure, and you say, okay, 60% of 1 million, it is 600,000. That means the inventory lost in fire is about $700,000. The retail method is acceptable for GAAP. To use retail method for calculating of ending inventory and then cost of goods sold. An inventory costing technique used by retailers that use the inventory values by applying cost to retail percentage to known sales and purchase transactions. Okay, how do we work with that? There's several methods for retail method, but here is just one. If you take intermediate accounting in your 4-year college for accounting major, then you will learn the other complete methods of retail method. But here it says, let's see if we can kind of make it easy. So beginning inventory is, let's say, 200,000 from last year, and that will end up to be like 266,667, because you know that your 75% of the cost is 75% of retail value that you are selling in average. So here, if I read it, the company sells poles that cost $750 for $10. So the cost is $750, but you are selling for $10, right? So $750 out of 10, that's 75%. This yields a cost to retail percentage of 75%. That means whatever your retail is, the cost is 75% of that amount. The beginning inventory totaled 200,000 at cost, and purchases were $300,000 at cost. We know already what was the beginning, and also we know what we purchased. And sales totaled $460,000 at retail. So we know also the sales was, because we always record the sales. Either you do periodic method or perpetual method, doesn't matter. You always know what you are selling. So their sales was 460. So let's look at this situation. 200,000 beginning inventory divided by 75%, 0.75. That gives us about $266,000 of retail. We purchased $300,000 of additional inventory, divided by 0.75, which is 75% of cost to retail percentage. That gives us 400,000 retail. If you add them up, if we sell every single inventory we have, it will be 666,667 retail sales price, if we sell everything. However, we know that our sales was $460,000. That's it. We know that. We have a record of that. Okay, so 666 minus 460, that gives us $206,000 at retail, which is good. But 460 times 0.75, which gives us the actual cost of the inventory that we sold. So that's the cost of goods sold, $345,000. And 500 minus 345 gives us the ending inventory, which is 155. And this method, retail method, is acceptable to use for preparing income statement and balance sheet. So the cost of goods sold ending inventory will end up to be 155, and then we use that to calculate, to prepare financial statements. By knowing what is ending inventory, we can calculate what is cost of goods sold right there, 345. and prepare our financial statement. So this is retail method acceptable by GAAP. Gross profit, it's a little bit easier, but it's just acceptable for estimation of inventory, maybe for fire type of issues or something. In regards to your exam, I'm not going to test you on retail method or gross profit method, but it's good to know. So here is the inventory management, or so-called how efficient the inventory is moving. And the good moving of inventory means the management doing good job, efficient business operation, and eventually also creating cash flow and liquidity for the company. So inventory turnover ratio is the cost of goods sold divided by average inventory, which we covered in chapter 16 that I explained in the beginning. But again, every time there is something at the end of each chapter anyway, related to that subject matter of the chapter. So inventory turnover ratio, that means how many times inventory has been sold and purchased again during the year. So you say cost of goods sold for the year divided by average inventory of the year. Average inventory is last year inventory plus this year ending inventory divided by 2, gives an average. And the reason you need average, because the cost of goods sold is about 12 months of cost of goods sold. Therefore, you have to have apple to apple. So apple to apple, you have to convert this inventory to an average annual inventory instead of just December 31st inventory. So you get an inventory turnover ratio, a number that how many times inventory has been turned over. And if you divide 365 days by number of inventory turnover, it gives you average daily, how many days it takes to sell the inventory. So if the inventory turnover ratio, let's say is 8 times, then 365 divided by 8, it will be like 45 days, I believe. And that means every 45 days, you turned over your inventory and bought a brand new inventory. And here is talking about inventory errors, which is overstating and understating of your ending inventory. So it starts with calculating ending inventory wrongfully. So if you are wrong on your ending inventory, and let's say you overstate your ending inventory, that means your cost of goods sold will be understated. And if the cost of goods sold is understated in the income statement, that means your profit is overstated. So if you overstate your ending inventory, you can easily overstate your profit in your income statement. And some management, they might like to do this to get their bonus. So they say, how about if we overstate our ending inventory here by $1,000, instead of 4,000, we say 5,000. And that way our cost of goods sold ends up to be understated. And therefore the profit will be overstated and we get our bonus. So in this example, if the income was 13,000, there was no bonus for management. And so here they get. So that is totally wrong, unacceptable, unethical, unlawful. And auditors, they always try to have a very good idea about ending inventory, correct balance, because they don't want such a thing to happen. If this happens by mistake, so all you need to do is just never repeat that mistake again, and everything will be corrected the next year. So the next year, the ending balance instead of 4,000 will be here becomes beginning balance, right? So the ending balance of 4,000, which is beginning balance of year 2, will be overstated, as you see here. So instead of 4,000, it will be 5,000. So that number is wrong because we did ending inventory is high. So because of that overstatement, if you do no more mistakes and you purchase properly calculated, ending inventory properly calculated, then cost of goods sold. So in this case, because the beginning is high, the cost of goods sold will be, and ending inventory is calculated properly, the cost of goods sold will be overstated. So the beginning inventory is overstated. That means cost of goods sold will be overstated compared to the correct version of it. And because cost of goods sold is overstated, then your gross profit will be understated. And that understated gross profit will clear this issue that here was overstated. So remember, in chapter 1, 2, 3, 4, we learned that profit, net income, goes in the retained earning eventually, right? So here, your retained earning eventually will be overstated by $1,000, right? However, in here, because now profit is understated by $1,000, so that means your retained earning will come back to normal, correct balance. So here, your retained earning was overstated because of overstated income. But if you make no more mistakes, it will correct itself automatically, and your retained earning statement balance will be automatically corrected as long as you don't make any other mistake. Okay, so chapter 9, I'm gonna skip it, leave it for your intermediate accounting if you become accounting major, but you can read it. It will be useful. In general, just so you know, you have 3 types of investment. Some investment you do, it's not investing. It is technically buying and selling the next day. That will be categorized as trading securities. You buy stock today, you sell it tomorrow. But sometimes you buy stock today and you probably going to keep it for a few months, 6 months or so or something. And then maybe you sell it, then you categorize them as available for sale. But sometimes you buy securities like stock or something of other companies, and your intention is to hold them for long term and collect dividend. So those are investment that will be classified as held to maturity. So there is 3 classification of investment, and that's what the chapter 9 is about, long-term investment. This is long-term investment is the second category of your classified balance sheet. The first category is current asset. The second category is long-term investment. Third category is PP&E, property, plant, and equipment that you use in your business on the daily basis. And the fourth category is intangible asset, which is intangibles. And the fifth category is other assets. So current asset, long-term asset, PP&E, intangibles, other assets. So here is the second category of classified balance sheet in the asset section. And those are how you classify these long-term investment as either trading securities or available for sale securities or held to maturity securities. So that's a overview of chapter 9.